Ever wonder why it feels impossible to get ahead on your mortgage payments? Maybe you've tried making extra payments but barely see a dent in your balance. Or perhaps you're curious about how some people manage to pay off their 30-year mortgage in just 15 years. I'm Bernard, and I turn my financial research into fun videos that break down complex money concepts into practical strategies you can actually use. Here's something interesting. While most people focus on finding ways to earn more money to pay off their mortgage faster, there's actually a lesser-known strategy that could help you become debt-free sooner without necessarily increasing your income. It's called velocity banking, and it's been gaining attention lately for its unique approach to debt repayment. The traditional advice of just make extra payments when you can sounds simple, but it ignores a crucial detail about how mortgage interest is calculated and how you could potentially use this knowledge to your advantage. Many people don't realize that the way their mortgage interest is calculated could be costing them tens of thousands of dollars in unnecessary interest payments. In this video, I'll show you exactly how velocity banking works and whether it might be a good fit for your situation. No fluff, no overselling, just a detailed breakdown of the strategy, complete with real numbers and examples. Here are 5 key things you'll learn today. 1. How to potentially save $79,000 in mortgage interest even if you don't have much extra money each month. 2. The exact mathematics behind velocity banking, even if you're not a numbers person. 3. A step-by-step breakdown of how to implement this strategy, even if you're starting from scratch. 4. The critical risks and warning signs to watch for, even if you have perfect credit. 5. A practical framework to decide if this strategy is right for you, even if you're unsure about using debt to pay off debt. Let's start with something that might surprise you about your mortgage. Every time you make your regular monthly payment, up to 80% of that money goes straight to interest in the early years of your loan. That means if you're paying $2,000 a month, as much as $1,600 could be going to interest alone. But here's where it gets interesting. What if you could change how that interest is calculated? This is where velocity banking comes in. At its core, velocity banking is about using a specific type of credit, usually a home equity line of credit, HELOC, to manipulate how interest is calculated on your debt. Now, before your eyes glaze over at the mention of more debt, let me show you exactly how this works with real numbers. Imagine you have a $300,000 mortgage at 4% interest. With a traditional 30-year mortgage, you'd end up paying about $215,000 in interest over the life of the loan. That's not a typo. You're paying nearly 3/4 of your original loan amount just in interest. But what if we could change that? Here's where things get really interesting. With a HELOC, interest is calculated differently than your mortgage. Your mortgage calculates interest on the entire remaining balance at the end of each month. But a HELOC? It calculates interest based on your average daily balance. This small difference is actually a game changer, and here's why. Let me walk you through a specific example. Meet Sarah, a homeowner with that same $300,000 mortgage we talked about. Her monthly payment is $1,432. Sarah gets approved for a $50,000 HELOC at 5% interest. Now watch what happens when she implements velocity banking. Sarah uses $30,000 from her HELOC to make a lump sum payment on her mortgage principal. Right away, her mortgage balance drops to $270,000. But here's the crucial part. Sarah's regular income still goes into paying off the HELOC balance instead of sitting in a checking account earning almost no interest. You might be wondering, but isn't Sarah just moving debt from one place to another? That's exactly what I thought at first too. But here's the key difference. Remember how HELOC interest is calculated on the average daily balance? Every time Sarah's paycheck hits her HELOC account, it immediately reduces the balance she's paying interest on. Let's put some numbers to this. If Sarah makes $5,000 a month after taxes, that money reduces her HELOC balance immediately when it's deposited. Even if she needs most of that money for monthly expenses, for the days it sits in the HELOC account, she's reducing her interest charges. Over time, these small interest savings compound into something significant. So here's a day-by-day breakdown of how this works. Let's say Sarah gets paid on the 1st and 15th of each month, $2,500 each time. On day 1, her HELOC balance drops from $30,000 to $27,500. Even though she'll use most of that money for bills throughout the month, for those few days she's paying interest on a smaller balance. Think about it. How much money typically sits in your checking account, doing nothing between paychecks? But wait, there's something else you need to understand about why this works. When Sarah made that $30,000 lump sum payment to her mortgage, she permanently reduced the base amount she's paying interest on for her mortgage. And since mortgage interest rates are usually lower than HELOC rates, she's effectively arbitraging the difference between how these two types of interest are calculated. Now let's talk about the real impact. By implementing this strategy and maintaining her regular income and expense patterns, Sarah could potentially pay off her mortgage in 18 to 20 years instead of 30, saving around $79,000 in interest payments along the way. And she's doing this without having to make drastically larger monthly payments. Let's look at another scenario. Meet Tom and Lisa, who tried velocity banking but had to adjust their approach. They started with a $400,000 mortgage and a $75,000 HELOC. Their initial results were promising, but 3 months in, Lisa's company announced a restructuring. Would their strategy still work with this new uncertainty? This brings us to a crucial point about risk management. But here's something crucial you need to know. Velocity banking isn't without risks. Remember how I mentioned that HELOC rates are usually higher than mortgage rates? This is where discipline becomes absolutely critical. If you don't maintain strict control over your spending and consistent income, you could end up paying more in interest instead of less. Let me show you exactly what could go wrong. If interest rates rise significantly, your HELOC payment could increase substantially. For example, if rates jumped from 5% to 8%, your monthly HELOC payment could increase by hundreds of dollars. This is why having a solid financial foundation is crucial before attempting this strategy. Consider this scenario. A homeowner named Michael implemented velocity banking just before the 2023 interest rate hikes. His HELOC rate jumped from 5% to 9.5% in less than a year. What did he do? He had to quickly adjust his strategy using his emergency fund to pay down a portion of the HELOC balance. This highlights why having that safety net is non-negotiable. There's also another risk that most people don't talk about, the psychological impact. Using a HELOC this way requires a complete shift in how you think about your money. You need to be comfortable seeing large amounts move in and out of your accounts regularly, and you need to maintain strict discipline with your spending. Have you ever wondered why some people succeed with this strategy while others struggle? It often comes down to their money management systems. Let's look at how successful velocity bankers typically organize their finances. They usually maintain 3 key spreadsheets, one for tracking their HELOC balance daily, another for projecting upcoming expenses, and a third for monitoring their overall progress. But what about alternatives? You might be wondering if you could achieve similar results by simply making extra payments to your mortgage. The answer is yes, you could, but it would require more cash flow each month. The advantage of velocity banking is that it can help you achieve similar results with the same monthly cash flow you have now, just used more strategically. Let's talk about who this strategy might work best for. Velocity banking tends to be most effective for people who have stable, predictable income, good credit scores, usually 720 or above, significant home equity, at least 20%, and most importantly, disciplined spending habits. If you're self-employed or have variable income, this strategy becomes significantly riskier. Here's a practical way to evaluate your readiness. Take your last 3 months of expenses and categorize them. How many were unexpected? How many were discretionary? If more than 20% of your expenses fall into either category, you might need to stabilize your spending patterns before considering velocity banking. Here's something that might surprise you. The best candidates for velocity banking often aren't the ones who need it most desperately. If you're already struggling with debt or having trouble making your current mortgage payments, this strategy could actually make your situation worse. The ideal candidate is someone who's already financially stable but looking to optimize their debt repayment strategy. This brings us to a crucial question. How do you know if velocity banking is right for you? I've developed a simple 3-part test. First, check if your mortgage interest rate is at least 2 percentage points lower than available HELOC rates. Second, verify that your monthly income is at least 3 times your mortgage payment. Finally, confirm that you have at least 6 months of expenses saved in an emergency fund. Let's break down that emergency fund requirement further. Why 6 months specifically? Because this gives you enough buffer to handle both routine financial fluctuations and potential HELOC rate increases. Think about it this way. If your HELOC rate increased by 3% overnight, how would that affect your monthly budget? Your emergency fund should be able to cover that increased payment for at least 6 months. Remember how we talked about those massive interest savings earlier? Those numbers assume you maintain perfect discipline with the strategy. The reality is that most people who try velocity banking don't achieve the maximum possible savings. But even if you only achieve half of the optimal results, you could still save tens of thousands in interest over the life of your loan. Here's a question many people ask: what happens if I need to sell my house while using this strategy? The good news is that velocity banking actually gives you more flexibility, not less. Since you've been paying down your mortgage principal faster, you'll have more equity in your home. Just make sure you understand your HELOC terms. Some have early closure fees in the first few years. Let me leave you with this final thought. Velocity banking isn't a magic solution, and it's not right for everyone, but for the right person with the right financial habits and situation, it can be a powerful tool for building long-term wealth through strategic debt management. The key is understanding both the potential and the limitations of the strategy, then making an informed decision based on your specific circumstances.